Hello and welcome. You know, Warren Buffett, the super successful investor, once shared that there's this book that totally influenced his investing style. He thinks it's not only the first book he has ever read on the subject, but also the most important one. That book he's talking about is The Intelligent Investor by Benjamin Graham, who is the father of value investing. It's considered a classic in the finance world. So what is it about this book that really left a lasting impression on Buffett's investment philosophy and played a significant role in his incredible success? In this exploration, we're going to dive into how The Intelligent Investor has had a big impact on Warren Buffett's investing style. We'll uncover the valuable lessons that still motivate investors all over the world. Thanks for checking us out. We really appreciate your support, and we'd love to have you join our community. If you've been enjoying the content and finding it valuable, it would mean a lot to us if you could give it a like, share it with others, and maybe even consider subscribing to our channel. Thanks a bunch. By staying updated, you not only get the latest insights and information, but you also help us grow and reach more people like you. We really appreciate your support, and we're excited to keep going on this journey with you. Thanks so much for being a part of our community. Warren Buffett considers The Intelligent Investor by Benjamin Graham as the very first and most crucial book he ever read about investing. There are a few reasons why this book really influenced Buffett's investment philosophy and approach. The first principle is all about having a margin of safety. The most important thing is to buy investments at prices that are much lower than what they're actually worth. The reason for this idea is to protect investors from any losses that could happen because of market ups and downs or unexpected economic downturns. Basically, it's like getting a dollar bill for a bargain price. A smart move that reduces risk and increases the chances of making steady profits in the long run. You know, there's this saying that investors love to throw around, buy low, sell high. It's all about getting in at a good price and making a profit when the time is right. The margin of safety concept is really great because it tells investors to buy when prices are low compared to the actual value of the investment. This way, there's a chance to make some gains when the market finally realizes how valuable the investment really is. This approach not only helps you become a disciplined investor, but also shows the wisdom of Benjamin Graham. He believed that being cautious and focusing on value can lead to long-term financial success while reducing unnecessary risks. Did you know that Benjamin Graham, who is known as the father of value investing, came up with a really important idea in his book, The Intelligent Investor? It's called the margin of safety. So basically, it's super important to get investments at really good prices that are way lower than what they're actually worth. Basically, Graham's approach lines up perfectly with the timeless advice of legendary investor Warren Buffett. Buffett always tells investors to be scared when everyone else is being greedy and be greedy when everyone else is scared. The margin of safety principle is all about being smart with your investments. It's about buying assets when they're a good deal, so you don't risk losing money. By doing this, you set yourself up for long-term success as the market eventually recognizes the true value of those assets. This strategy is pretty cool because it not only encourages smart investing, but it also shows how Benjamin Graham's wisdom has stood the test of time. And even Warren Buffett himself endorses it. Principle number 2 is all about having a long-term perspective. It's important to embrace the idea of looking ahead into the future. It's all about how important it is to take a long-term approach when it comes to investing. Graham suggests that instead of getting influenced by short-term market ups and downs or trying to predict where the market is heading, it's better for investors to have a patient approach. This principle reminds me of a famous saying often attributed to Warren Buffett, who is a well-known figure in the investing world. He once said, "The stock market is designed to transfer money from the active to the patient." If you think long-term as an investor, you can take advantage of compounding, ignore all the noise in the market, and make smarter choices based on a company's real value instead of temporary trends. I totally agree with you. It's so important to think about the bigger picture and not get caught up in short-term thinking when it comes to achieving long-term financial success. Let's talk about principle number 3, which is all about diversification. The Intelligent Investor really emphasizes how crucial it is to diversify your investment portfolio. The idea behind diversification is that when you invest in different types of assets and industries, you can lower your risk and make your portfolio more stable. This idea lines up with what investment guru John Templeton used to say. He believed that the only investors who shouldn't diversify their investments are the ones who are always right, like all the time. Diversifying your investments is a smart move because it helps you reduce the impact of any underperforming assets, while also giving you the chance to benefit from the potential growth of others. Oh, I totally get it. This strategy is all about understanding that investments can be unpredictable. It's like not wanting to risk everything by putting all your eggs in one basket, right? It's all about protecting your financial well-being. Basically, diversification is a key strategy for managing risk and creating a well-rounded investment portfolio. Oh, principle number 4. Let's talk about fundamental analysis. Fundamental analysis is a big deal in investing, and Benjamin Graham's book, The Intelligent Investor, really drives that point home. It emphasizes the importance of digging deep and thoroughly analyzing the fundamentals before making any investment decisions. Instead of getting influenced by short-term market trends or speculative factors, Graham suggests taking a closer look at a company's financial health. This involves examining its earnings, balance sheets, and overall financial statements. This idea reminds me of something Peter Lynch, a famous investor, once said. He cleverly stated, "In the short term, the market is like a voting machine, but in the long term, it's more like a weighing machine." So basically what this means is that even though people's feelings about the market can change quickly, the real value of a company can be determined by looking closely at its basic factors. If you want to make smarter investment decisions and set yourself up for long-term success, it's important to consider the underlying strength of your investments. This is a key principle that both Benjamin Graham and Peter Lynch emphasize in their investment philosophies. Principle number 5 is all about market fluctuations. The Intelligent Investor by Benjamin Graham is a great book that teaches us how to handle market fluctuations. Graham suggests that investors shouldn't let themselves get caught up in the ups and downs of the market. Instead, he encourages them to view these changes as chances to make smart moves. This principle reminds me of what Sir John Templeton once said. You know, the best time to buy is when everyone is feeling down and pessimistic, and the best time to sell is when everyone is feeling super optimistic and confident. It's like he knew that timing is everything in investing. Basically, when the market gets crazy, investors can stay calm and make smart decisions. Instead of letting fear or greed guide them, they can take a rational approach. This means they can take advantage of the opportunity to buy stocks that are undervalued and sell when assets are overpriced. Graham's advice is all about keeping a long-term perspective and using fundamental analysis to make smart investment decisions, even when the market gets unpredictable. It's all about getting the best outcomes for your investments. Principle number 6 is all about making the most of market fluctuations. The book is really interesting because it teaches us an important lesson about how to handle market fluctuations. Graham suggests that investors shouldn't let themselves get caught up in the ups and downs of the market. Instead, he encourages them to see these changes as chances to make smart moves. This advice is in line with what legendary investor George Soros once said. You know, the stock market is full of people who only care about prices, but they don't really understand the true value. Basically, instead of letting fear or greed take over when the market gets rough, investors can take a rational approach by taking advantage of the opportunity to buy stocks that are undervalued and, on the other hand, selling when assets become overpriced. Graham's wisdom reminds us how crucial it is to have a patient and thoughtful approach when dealing with the ups and downs of financial markets. By focusing on fundamental analysis, we can make smart investment choices for the long run. Let's talk about principle number 7, which is all about the difference between an investor and a speculator. Benjamin Graham really breaks down the differences between these two approaches in the finance world. He's a big advocate for investors who focus on long-term value and protecting their capital. This philosophy lines up with what famous investor Charlie Munger said, which is basically that the real money comes from being patient rather than constantly buying and selling. However, Graham wants to remind us to be careful about always trying to make quick money and taking unnecessary risks. I think it's really cool how he focuses on investing instead of speculating. It just goes to show how important it is to be patient, disciplined, and have long-term financial goals. It's all about being a responsible financial steward, just like Graham and Charlie Munger teach. Principle number 8 is all about the importance of bonds. Benjamin Graham talks about how important bonds are for a balanced investment portfolio. He really emphasizes their role in keeping your portfolio stable. This viewpoint lines up with what Ray Dalio, a really successful investor, believes. He once said that the best investment strategy is to have a diverse portfolio with a good mix of different types of assets like bonds. Bonds are great for people who don't like taking risks because they provide stability and a steady income. Graham really emphasized how important it is to have a good mix of different investments in your portfolio, including fixed income securities like bonds, can help balance out the risk and make sure you're getting a good return. It's all about having a strong and protected investment strategy. Principle number 9, which is all about active versus passive investing. Benjamin Graham really goes into detail about the different approaches to investing, both active and passive. It's quite fascinating. He understands that the decision between the two options varies depending on each person's specific circumstances and preferences. This perspective reminds me of what John Bogle, the founder of Vanguard Group and a big supporter of passive investing, once said, "When it comes to investing, you actually get what you don't pay for." Graham really emphasizes how crucial it is to match your investment strategy with your goals, how much risk you're comfortable with, and how long you plan to invest. It's all about finding the right fit for you. It's great to see that it recognizes that there isn't a one-size-fits-all solution. It encourages investors to make informed choices that fit their own financial situations. This principle combines the wisdom of both Benjamin Graham and John Bogle. Let's talk about principle number 10, continuous learning. The Intelligent Investor by Benjamin Graham really stresses the importance of always learning and adapting when it comes to investments. Graham's perspective totally lines up with what legendary investor Charlie Munger once said. He famously stated, "I've never known any wise people in my life who didn't read all the time." Graham really emphasizes the importance of continuous learning. It's because the investment landscape is always changing and evolving. It's important for successful investors to always stay informed, adapt to changing conditions, and refine their strategies to navigate the complexities of financial markets effectively. It's like a little reminder that helps them stay on top of their game. Basically, if you want to be good with money, it's important to always be open to learning new things. This is something that Benjamin Graham and Charlie Munger, who are both really smart when it comes to finances, believe in.